African bank investments, first half headline earnings per share increased 25% to 170.4 cents. The bank expects the current economic environment to continue for the rest of the financial year. And here is company CEO Leon Kirkinis on the highlights of their earnings.
What's nice about this set of results is that there's no silver bullet. It's just a whole lot of things actually all coming together at the same time in a fairly challenging environment. But being able to get all these things aligned so that they kind of deliver a result with an ROE, which we wanted to get above 20% for the full year, and we got there in the first half of the year. So I think that's pretty cool. That in itself is obviously also a reflection of restoring the return on assets and then gearing it a little bit to a nice return on equity.
Okay, so let's talk about the banking ROE. 22.9% is credible. Where do you want it to be? What is that four-year plan that you've got on the cards?
In excess of 30% over the next 4 years. And so that's going to come from, again, no silver bullets. It's going to be like the yield, the cost to advances coming down, the risk to advances coming down a bit, lower funding costs. So a combination of all those things will actually give us the return on assets that we'd like. We'd like to get the ROA up for the bank from the 5% level to around 6.5%, then gear that about 4.5 times, and then you get to your 30%. That's not easy, but I mean, that's kind of, we like to set ourselves some stretch targets.
You talk about the rapid expansion and the impact that has on the business in terms of creating embedded inefficiencies. Talk to us about where your cost-to-income ratio sits right now.
Look, the cost-to-income ratio is sitting at below 20%. And we'd like it to come down further, down to the lower teens. It's important to get our efficiencies. We've traveled a 5-year journey of getting quite a lot of operating leverage in the business. I think the last 2 years we've kind of given some of that up, and so we went for growth, and now we need to make sure that we start embedding, taking out those inefficiencies you were talking about and embedding some operating leverage again.
In terms of the business right now, I mean, just looking at the numbers, net advances up by 36% to 41 billion rand. You've got interest income from advances outweighing, obviously, non-fee income coming through. That was up by 32% to 4.55 billion rand. The golden question everyone is asking is, how long are we going to continue seeing growth like this in loans?
Look, it obviously gets, as your base gets bigger and bigger, it's always more challenging to grow at this rate. That's why we've indicated that if you take a 4-year out view, you look at a 15% compound annual growth rate. It obviously won't be straight line, but you're not going to grow at 35% on an annual basis every time. And therefore, you need to make sure that the other pieces deliver the ROA that you need to try and...
All the banks have now started looking at the unsecured lending space. They all see the attractive margins. They've all started aggressively trying to tap into it. Are they starting to bite into ABLE's market share in any meaningful way?
I hate the concept of market share, because if you get fixated on market share, you're going to get yourself into trouble. And that's what happens all the time worldwide when people are chasing market share as opposed to chasing returns. So there's no doubt that we would have given up some market share. I personally don't worry about market share. It's not something that I lose sleep over. For me, I'd rather be much more interested in ensuring that we are relevant to our customers, and that where we lose relevance to our customers, we raise our game.
So what is the focus now then on the furniture side and the retail side of the business?
The future is focused very much on this operating leverage. We don't think that the market's going to suddenly become easier in the next couple of years. I think we're in for tough economic times around the world. So I think it behoves of us to make sure that we drive efficiencies. So for example, the big DC distribution center rollouts are taking place by January next year. That'll be completed. Now, that's a huge program. 5 massive DCs around the country, taking out then the inefficiencies that existed where previously there were 200 warehouses that stored all this furniture. The timelines in the furniture industry are actually quite long. So it takes quite a few years to get it right. But what you can see in the set of numbers is finally that actually that kind of is now becoming evident that we've turned the corner.
Credit impairments increased by 38% to 2.3 billion rand during this half. Where's that impairment coming through from? Just tell us about the process in terms of booking those impairments on the balance sheet.
Yeah, the impairments come as the NPLs come. So effectively, as your NPLs emerge, and in our case, NPLs are any loan with more than 3 missed installments on it, in totality, not in consequence or not sequentially. Then we raise provisions, and that's where the charge comes through. So we've obviously, and the first half is always going to be higher than the second half because December and January are relatively poor collection months. And so, and also, if you look at it, the NPLs that come through now have come from business that was written about 8 months ago. So it's in our peak time, peak business, then starts to come through the charge line like around now.